So I'm going to spend a few minutes running very briefly through three important topics of the day. The first is going to be the fiscal cliff that David Gergen talked about, and I'm going to run through some of the specifics of why it's so important. The second is going to be the Federal Reserve and what they are trying and not trying to do, and then the third will be how we're seeing the stock market right now. Just by way of background, so you know where I'm coming from, BTIG is an institutional trading and research operation. Our clients are exclusively large hedge funds, large mutual funds, and so on and so forth. I do almost no conversations with retail clients. I'm meeting with names of people you know at hedge funds and so on and so forth. So a lot of what I have to say, to some degree, is going to be reflective of the investment community. And I'm deliberately steering clear of politics, much to my dismay, because it's one of my favorite topics. But a lot of what I have to say is colored somewhat, not necessarily only by how I feel, but also by what a lot of our clients are telling us. So that said, we're going to run very quickly through what the fiscal cliff is. You've heard a lot about it. Let's just discuss very quickly. In no uncertain terms, because our country is run by idiots, we have... Thank you, good night. We have set ourselves up for what is called a fiscal cliff, but is really a fiscal slope, so to speak. There's a number of tax and spending provisions that are set to expire at the end of the year, as they always are set to expire. This time around, though, the numbers are much larger. As you can see here, the largest are the Bush tax cuts in general, but there are a number of other provisions, specifically the payroll tax cut, for instance. At the end of this year, there's nobody in Washington who wants to renew the payroll tax cut. Anybody here who has a job will see his paycheck go down by about 2% next year. Right now, we're all getting an extra 2% in our checks. That will go away. But that's what we would call small potatoes in the context of what will amount to be somewhere around, let's say, 4% of GDP in terms of tightening. Spending provisions will be reduced, tax increases will be imposed, and this amounts to about 4% of GDP. What does that mean? Well, the economy is growing, as I'm sure most of you know, somewhere around 1.5% to 2.5% right now. Not recessionary, but certainly not booming. Simple arithmetic tells us if you were to tighten policy by about 4% of GDP for an economy growing about 2%, you would by definition be in recession. And I know David Gergen said likely. I'm here to tell you assuredly. The US economy will assuredly be in a recession in the first 6 months of next year if this entire cliff happens and stays. And there's a lot of different ways that we look at this. Up on Washington, David's exactly correct. There is no appetite for this. Everybody wants to extend these provisions most likely by 6 to 9, perhaps even 12 months. I can say with certainty that I am the only, lack of a better word, major economist or strategist on Wall Street who believes that going over the fiscal cliff is the base case scenario, meaning in our forecast we expect it to happen. There are a number of reasons why, and I won't draw these all out, but simply put, David brought up Grover Norquist. I think this is an important part of the conversation. As everybody should know, virtually every Republican in the House and Senate has signed a bill that prevents them from voting to raise taxes. Legislatively speaking, on January 1st at 12:01 a.m., everybody's taxes will go up. In theory, at 12:02, Republicans could vote for a tax decrease on 98% of the economy. Technically, that means 2% of us in the higher income brackets would see our taxes go up, but technically speaking, no Republican will have voted for it. This is one possible way that the fiscal cliff actually happening, although not for a long period of time, but happening nonetheless, is being viewed by us as the base case scenario. I could go into greater detail, and I'm going to stick around for a little bit while after this. If you'd like to talk more, please come see me. Now, in terms of the Democratic perspective, as David mentioned, and he's stealing a lot of my thunder, so I will refer to him repeatedly, there are several leading Democrats that think going over the cliff is not the worst idea in the world, particularly Patty Murray, who's the head of the DSCC, senator from Washington State, has openly said if Republicans will not agree to higher tax rates, which, as the president said, was the central theme of the election, well, then let's go over the cliff and discuss things from there. The chart I have up on the page shows the history of marginal tax rates for income, corporate, and capital gains going back to, let's say, the 1910s. And as you can see, there has been, and for good reason, a generalized decline in tax rates over the last 30 years. Democrats look at this, and everyone's familiar with the talking point, well, we'll just go back to the Clinton-era tax rates. Irrespective of whether that is an appropriate policy choice or not, What the chart shows is that an increase to 39.6% on the top marginal tax rate from a Democratic policy perspective is but a drop in the bucket compared to what we've seen over the last couple of years. So there's a lot of reasons, again, to believe why the fiscal cliff might happen, one of which is, from the Democratic standpoint, the central theme of the election was raising the top marginal tax rates. I follow politics as closely as anybody I know, and I am at a loss to say what the president would do in his second term from any vantage point except for raise taxes on the top income tax brackets. My personal policies aside and our personal views aside, the president does get to walk into the room and say, we campaigned on raising tax rates and the majority of the voting population agrees with us. So the president does have a little bit of leeway here. Whether the House moves in his direction or not is, of course, an open question. But I do believe, and we all should be under the impression, that the president won. John Boehner has privately told House members, we lost, and we have to, quote unquote, get in line in no uncertain terms. Now, how important is the cliff to our country? Well, as I mentioned, be under no illusions, the US economy will be in a recession in the first 6 months of next year, if not a touch longer. And what we have here is, if you were interested in where all our money comes from and where it goes, this is, the government operates in a 10-year window. These are the numbers that tell us how much money we're going to take in, how much money we're going to spend, and what our assumed deficit is over the next 10 years. This chart, this table shows us if the cliff actually happens, if spending is cut, if tax raises are, if tax increases go into effect, well then over the next 10 years, the US government is going to incur deficits of about $2.3 trillion. That is a lot of money. I'm about to show you a chart that has you screaming for $2.3 trillion. How important is the fiscal cliff? Well, the CBO, the Congressional Budget Office, which is the scorekeeper for legislation in Washington, puts together an estimate for us, and it repeats in the top here, well, if everything happens, we're going to incur deficits of $2.3 trillion. If we ignore everything, if we delay everything, we're going to incur deficits of nearly $10 trillion. So getting back to my point about Patty Murray and the Democrats, if you believe that the #1 priority for the US economy right now is to solve the long-term deficit problem, well then, many Democrats would tell you, just do nothing. On January 1st, taxes will go up, spending will be cut, and instead of running $10 trillion worth of deficits, we will incur $2 trillion worth of deficits. And I would add the CBO, again, the Congressional Budget Office, the arbiter, the scorekeeper of this stuff, says the economy would be better off in, let's say, the 2 to 10-year window if the cliff actually happens. There's a lot of ammunition in the Democrats' corner right now to allow something tilted in their favor to occur. Now that said, I keep talking a lot about January 1st at 12:01. Let's be under no illusions. We don't have to wait until January 1st to see something start to happen. And indeed, we're already seeing the economy start to slow down from its already weak pace. The chart I have here is what economists use to gauge business spending. This comes from it's a subsection of a government report that none of you care about and will never ever look at. But what the chart shows you is effectively the year-over-year change in these orders that we use to gauge business spending throughout the entire economy is plunging at, roughly speaking, a 30% annualized rate, a rate not seen outside of recessions. Now, I don't think we're going into a recession right now. We might if the cliff happens, but what the chart is telling you is when, strike that. When you talk about businesses slowing down in front of the cliff, when you talk about uncertainty and executives don't know what to hire, who to hire, or what to invest in, this is the chart that illustrates that point as best as any chart you will see. Again, year-over-year change in business orders plunging at about a 30% annualized rate. Now, we'll move on from the fiscal cliff. I don't want to talk all day. We'll get to the Federal Reserve, arguably the most hated institution in the United States right now, outside of every other. The chart on the left is, when you talk about the Feds printing all this money and they're buying all this assets, the chart on the left is the chart of the Federal Reserve's balance sheet. It goes back into the mid-1990s. You can see that it steadily increases as it's supposed to. It goes up at a fairly steady pace. You got to about $900 billion, and then Lehman Brothers happened. And the line straight up to now $2 and change trillion shows you the degree to which the Federal Reserve has expanded its balance sheet, has printed money, and purchased assets throughout the economy. The pie charts on the right, one is from March of 2007, well before the crisis really took hold. The bottom is the most recent Federal Reserve balance sheet. What you can focus on is the blue part of the circle. In March of 2007, 90% of the Federal Reserve's balance sheet was US Treasuries. That's what they're supposed to do. They manage the money supply, and they do that by buying and selling Treasuries in the market. Nobody says a word. Today, that number, that 90% number, is down to 58%. Instead of 90% of the Fed's balance sheet being the safest assets, U.S. Treasuries, it is now 58%. And why is that? Well, they have started to buy other assets, from particularly troubled mortgages. From zero to now well over $1 trillion, the Federal Reserve is a central part of the mortgage market, helping to spur, or aiming to spur, home buying in the U.S. economy. Now, I mentioned earlier the U.S. economy is growing about 2.5% or so. It feels like things are okay-ish. We're not in a recession. Things could certainly be much better. What the hell is the Federal Reserve thinking by doing what it's doing? This chart is a very complex economic topic boiled down into blue diamonds, red squares, and green triangles, a very Lucky Charms-ish way of looking at a fairly difficult concept. Effectively, what this chart compares is, on the left, the number of job openings throughout the economy. 3 million jobs are open, 4 million jobs are open, against the unemployment rate on the bottom. And what you can see, before the recession, the blue diamonds, for a given level of job openings, let's say 5 million, the unemployment rate was quite low. As businesses were looking for more people, it meant the economy was strong, and so the unemployment rate was low. Then you have the recession itself. During the recession, in red squares, you can see there's a steady drift to the right, meaning for the same number of job openings, the unemployment rate is now higher, until finally we settle in where the green triangles are. This is since the recession. And what you can see, whereas in the past, 3 million job openings would get you a 6% unemployment rate, 3 million job openings now gets you a 9% unemployment rate. That says there's something wrong in the economy. And I'm not going to get into it right now because it's incredibly boring. But if you believe that you can turn these green triangles back into blue diamonds, well, then you're going to expand the Fed's balance sheet. If you do not, then you do nothing. The Federal Reserve believes that they can improve the unemployment rate and the labor market in general, and that is why they're doing what they're doing. And there's much work to be done. This chart here is every recession in the post-war era, from all the way on the left, which is the peak amount of employment, to the right when you return to whatever the previous employment level was. And the blue line at the bottom is the current recession. And what you see, obviously, is this was the deepest post-war labor market contraction we've seen by a magnitude. And here we are nearly 60 months later, give or take, and we're not even close to returning to the zero line, which means we'd have the same number of people working. And the reason why people think we're still in a recession is because the economy is now bigger than it was before the crisis, and we've achieved that level with 4 million fewer jobs. And that's why people look around and they go, I just don't feel it. And there's more to that discussion. I will not get into it because it is also very boring. But this is also a chart that the Federal Reserve either explicitly or implicitly looks at and says we should be buying more assets. And indeed, let's be clear, at the end of this year, they will probably buy even more. What they have not done, though, is destroyed the dollar. And this is, despite my political leanings and predilections, a talking point that is unfounded. What you have here is the chart on the left of the US dollar since 2007. Everybody's fond of saying Barack Obama and Ben Bernanke have destroyed the dollar. They have not. The chart on the left is since 2007. The US dollar, based on this measure, is higher today by a couple of percentage points than it was in April of 2008, before the crisis really got going. More importantly, though, is the chart on the right, which shows the dollar going back to Nixon's breaking of the gold window. And I want to draw your attention to the 1980 whatever peak. That is, to the day, the Plaza Accord in the United States, where the US government decided that the US dollar was too strong. We bothered every other country. We pulled them into the United States to meet at the Plaza Hotel in Manhattan, and we coordinated a weakness in the dollar. The US economy and US governments have not had a strong dollar policy since. 30 some odd years. Ben Bernanke and Barack Obama are no more complicit in destroying the dollar than has been every other president, save Bill Clinton, over the last 30 years. Perhaps most scaringly, though, a lot of people are concerned about the Fed spurring inflation. I don't think that's founded in any way, shape, or form. People who tell you should be scared of inflation don't understand the current situation. I apologize if anybody in here is telling other people that. That said, there is most certainly a debt problem in this country, and this is the chart that best illustrates it. It's federal debt as a percentage of GDP going back to 1792. You really can't get a better, more illustrative chart of the problems. And you can see we had the spike up around World War II. We obviously had to borrow to fight a war to destroy the evil empire. And yet here we are, and we're coming up very quickly on that level. This is a major problem for the US economy going forward. However, I should add, it is not the debilitating, immediate crisis that you are being told. It is a problem over the next 10, 20, 30, 40, 50 years. It is not a problem and has never been a problem over the next 1, 2, or 3 years. There is a moment where it becomes a problem. We are not there yet. Now, finally, I will end with just a couple of slides on US stocks, which is ultimately what my main job is and what my clients really care about. Despite all this uncertainty about the Federal Reserve, I haven't talked about Europe or what's going on in China, US stocks are having a pretty good year. The chart on the left, compares the US stock market this year to other election years. We're on track to match the Reagan re-election best stock market performance during an election year we've had. That's the line in red. The chart on the right, as of about a week or two ago, plots the US against every developed major equity market in the world. And other than India and Germany, the S&P 500 was and is the best place to have put your money. Contrast that with a number of other places, including China, the second biggest economy in the world, where its stock market is down on the year. Despite everything you've heard, the S&P 500 is having a terrific year. And the reason why that might be, despite the problems we're having, is because there is no correlation whatsoever between how an economy performs and how the stock market performs. And this a lot of people don't get. A lot of people think, well, if the economy is not growing, how can the stock market really go up? And the simple answer is because an economy measures, GDP measures the output of an economy, so to speak, all the goods and services that are produced in an economy. The stock market does not measure that. The stock market measures the profitability of that output. And what you've seen during this current recovery is, I mentioned earlier how the US economy is now bigger than it was before the crisis, and we've achieved that level with 4 million fewer jobs. What does that mean? That means companies are employing 4 million fewer people. That means they're paying 4 million fewer salaries, and that money flows directly to the bottom line, which has doubled S&P 500 profits since the bottom. We'll skip this slide and I'll move on, but I want to end with a chart I've had in my presentations since I became a strategist about 6 or 8 years ago. It is, I would argue to you, the single most important chart you will see for understanding how to invest over the next couple of years. I cannot overstate this enough. It is not a joke. I end every presentation I've ever done with it, and I don't know that too many people are running around with it. This is a chart of the Dow Jones Industrial Average going back to the late 1800s. And what I've done is I've broken the chart down, as some other people do who have this chart, into what technicians call secular bull and secular bear markets. These are periods of time of about 15 to 20 years. There's all sorts of in-depth analysis I could give you on this, but the short version of the story is stocks sometimes go sideways for 15 to 20 years, and sometimes they go up for 15 to 20 years. Since 2000, we've been going sideways. I was down in Dallas not that long ago, meeting with a father-son family office. They manage $200 million, whatever the number is. And he had on his wall the front page of the Wall Street Journal from the day his firm opened. And the day his firm opened, the S&P 500, I'm making it up, but let's say it was at 1410. Well, the day I was in his office, I was meeting with him for a breakfast meeting at 8:30 till about 10 o'clock. The S&P opened at about 1425. In the last 10 years, the S&P had gone up 10 points. That's atrocious, and that is the red box all the way in the top right. Now, I will end with this point. What does this mean? Well, if this is going to last, as history suggests, 15 to 20 years, we are completing the 12th year of the current one, meaning there's probably some additional troubles going forward. Now, what brings about those troubles? I would need another 2 hours, but if history is any indication, this is not Barack Obama's fault. It's not George Bush's fault. It's not Larry Summers' fault or Ben Bernanke's fault. Equity investments tend to go in cycles, and we're in one of those, you'll pardon me, crappy cycles right now. It's likely to last a little while longer. It's part of the reason why bonds are doing what they're doing, and I don't believe bonds are in a bubble. But it's the type of thing I like to remind people of when they talk about how the Reagan bull, wow, we would just get back to the Reagan bull market. Everything he did was great, although I would argue it was the Volcker bull market. It's a little more complicated than that. And we've got a couple more years of difficulty ahead of us. Europe is imploding on itself. China is changing its leadership for the first time in 10 years, as it's scheduled to do. And the US is suffering through a debilitating crisis. And how we emerge from this is going to speak to whether or not we enter one of these next green boxes. I would argue we can. We just need to implement the right policies. And as David Gergen ended his, I will end my speech by saying, if you implement those policies, there's smooth sailing, so to speak, but we have major problems facing the US economy, and the sooner we address them, the better. Thank you very much.
Thank you, Dan. Kachikori. Thank you, Dan. Now we're going to have Dan Hunt, who is going to share his considerable expertise on the Affordable Health Care Act and fill us in on what we can expect as the country continues to implement the law. Dan?
Thank you. So I think I can probably profess to being a considerable expert on the Affordable Care Act because I actually read the thing cover to cover, all 2,753 pages of it. I think that makes me probably the only person in the country to have actually done that. This is just a little insight. There actually are several instances in this bill where there are actually like 3 Section 5136s. They just happen consecutively, one right after the other. I mean, it's literally, it was put together with such speed, shall we say, with such duress because of the changing nature of the Senate and so on, that it really is quite a piece of work. But I have worked through it myself. The message today is that story time, though, is over. Because since I've been a healthcare investor for 10 years plus, since 2009, we've been in story time. Both sides have been telling narratives about Obamacare, neither of which have any bearing on reality. On the left, we've been told that it's, the culmination of 100 years of effort, a progressive ideal of getting everybody in the country covered and bringing an industry to heal. That is not correct. On the right, people have been talking about a government takeover of healthcare bordering on even worse. That is manifestly not correct. But we are now, we have been told these stories for one reason, right? Because it was thought to be the defining feature of this election. That election is now over. It was not the defining feature. In fact, the exit polls showed that the people coming out of those polls had approximately the same view that they've had about Obamacare the entire time, which is actually slight majority not approving of it. And yet, we had the electoral result that we did. The story time is over, and we're going to wake up into the policy environment. The policy environment is what I want to talk about a little bit today. But one of the things that I wanted to talk about a little bit, though, is I like to talk about 3 quick anecdotes. Because this narrative of the government takeover of healthcare has been particularly powerful, and it is particularly impactful to me as a healthcare investor because theoretically it would make healthcare investing very, very unattractive. In fact, healthcare has been one of the best performing sectors in the economy over the last couple of years. Okay? There's several reasons for that, but I would submit that one of them is not that Obamacare is a government takeover of healthcare. So the pharmaceutical industry hated this bill so much that they spent $150 million advertising in support of the bill. They hated it that much. Anecdote number 2, I sat across the table of a guy named Chip Kahn in probably May of 2010. The bill had just gotten signed. Now, Chip Kahn means probably nothing to you, but he was a famous House staffer. He was the House staffer that came up with the Harry and Louise advertising campaign that was widely credited for killing Hillary Care back in 1994. This was the guy. I was sitting across the table from him. He was then the head, and still is, the head of one of the big hospital trade associations. And I asked him, what scares you most about Obamacare? He said, I'm mostly scared that the Supreme Court will strike down the individual mandate and the bill's going to die. Well, look, why is that? The single biggest problem that hospitals have is bad debt. Okay? Bad debt is a big problem, and it comes directly out of the bottom line of hospitals. This bill is very, very important to the hospital industry. In fact, the hospital industry gave up probably more than any other industry when you think about the pay-fors, right? They still supported this bill. And Chip Kahn, the guy that killed Hillary Care, told me so. Third, the health insurance industry is probably the most maligned of any of the industries during this whole Obamacare debate. And I can't name names and I can't tell you direct dates. All I can say is that I've sat across the table from the managers of the biggest public health insurance plans in the United States of America, and I can tell you with absolute certainty that the ones that are prepared to operate in this environment like this bill very, very much. Now, it was very critical that they did not have a public option, which never really had the votes to pass. But other than that, what part of 32 million new lives do we not understand? Okay, so let's think about this for a second. The health insurance industry makes money 2 ways, pricing and enrollment growth. Well, they've been pricing. They've been pricing very effectively. I'm sure all of us are aware, right? That is a game that can go on for so long. But in terms of enrollment growth, nothing was happening. we've been in jobless recovery after jobless recovery, to be quite honest, right? And so what happened in the health insurance industry? They consolidated to gain lives, right? But this was becoming a zero-sum game. They needed Medicare lives, and they needed more customers. Medicare lives they got through Medicare Advantage in 2003, the Medicare Modernization Act, okay? And additional lives in terms of the private market they got through this. This is a hunting license for 32 million new customers. Now, does it come with strings attached? It does. But that's what this bill was about. This was not a government takeover of healthcare. This was, in fact, opening up of the Treasury's veins to flow into that industry with strings attached. And that is both one of the things that is least understood about the bill. It is also the thing that actually makes it the most problematic. But let's dispense with a couple other things right away, too. Okay, so it is the law of the land. There are a couple stories that continue to float around about how this may or may not come to fruition. Okay, so one of them is what happens with the exchanges. Now, I understand that the Western Growers has a health insurance plan of its own, that a lot of you guys access health benefits for your employees and so on. So at the end of the day, right, this bill is the law of the land. But there are still some states, right, that are predominantly Republican governors, Republican legislatures that have said, well, that's fine, but we're not going to set up the exchanges. Knock yourself out. Now, I can't quite understand exactly why they're doing this, because in the bill itself, again, I have read it, in the bill itself, it stipulates that the federal government, if the state doesn't set up the exchange, the feds will do it. So now the question becomes, the states have been allocated money to do this, but the federal government, shockingly, strangely, like I said, a lot of glitches in this bill, the federal government did not allocate any money to itself to set up these exchanges. So my point here is, for the Republican governors and the Republican legislatures that feel like not setting up state exchanges is going to kill the bill, they are incorrect, but it's going to be messy, right? It's going to be messy because we're going to get to a point in the middle of next year where the feds are going to basically have to set up exchanges with essentially no funding. So my point here is, it's not going to kill the bill, but it does make it a mess. In terms of the Medicaid expansion part of this is actually going to be optional. The Supreme Court told us that. So it's not really impactful to you, but it is a piece of the bill that has changed. Now, speaking of the bill changing, and I'm going to spend a couple of minutes on some of the employer mandate portions of this, which I imagine are of interest to you. I am not an attorney, but I am going to go through a couple of the most impactful things, largely to talk about how I think the bill will change in this respect. Because actually there is the most bipartisan consensus that the most problematic part of the bill is actually the employer mandate portion of the bill, the part that talks about penalties if your employees get access to subsidies and so on and so forth. The reason is because there is a minefield of unintended consequences. I'll give you a couple of them. But there is going to be change to the employer mandate portion of the bill, and it is going to be a bipartisan set of changes. I'm quite confident of this. So here's an example. One of the penalties that you could be liable for as an employer is the following. If you offer coverage, if you have a health benefit, but if it is unaffordable to even one of your employees, and even one employee takes a subsidy from the government, then you're on the hook for penalties. Not only for that employee, but for every other employee that does exactly the same. But here's the catch. The way that is defined as unaffordable, right, the reason why your employee would go off and get a subsidy is on the basis of 9.5% of the employee's family's total disposable income. Well, how in the world do you know what the family disposable income is? There's absolutely no way that you know that. And of course, everyone else knew this as well. So in fact, and if you are extremely technical, or I should say, have your lawyers go look at IRS 2012-58. Because in it, there is one of the most amazing little bits of regulation. What it does is it says this particular piece of penalty, right, the one for if this is unaffordable to your employees, they say the following. This is the most technical I'm going to get in this entire talk, but I want to use this as an example of what the unintended consequences can be. So what it says is, this business about total family income, this is unworkable. Employers aren't going to know this. What they'll know, though, is what the W-2 wages of their employees are. So here's the deal. If your health benefit costs more than 9.5% of that employee's W-2 earnings, right, for a single person's policy, then you're liable for penalties. But if it's below, then you're not. So here's what happens. I'm going to cut right to the chase. An employer will cap all premiums at 9.5% of the employee's wages. But for family coverage, off the charts. Guess what happens? That employee will have absolutely no choice but to go onto the public exchanges, and you will not get penalized as an employer. This is going to happen over and over and over again. It's an amazing thing that the IRS could do this individually. This is a clear attack at some one of the big central tenets of the bill. But again, my point here is there are so many unintended consequences in the employer mandate portion, many of which your attorneys will no doubt be calling your attention to in the months and days to come. But this is going to change. So the final thing that I want to talk about today, and again, I'm not going to get into any more technicalities than that because it's going to put you all to sleep. But the most important thing that we're going to be looking at going forward, and the most important thing for investors going forward, is the big battle to come, right? The big battle to come is about cost. And no matter what you've been told, any of the narratives you've been told about this bill containing costs, or this bill bringing down utilization of health care, or this bill controlling prices and so on, they are really all false. There is nothing with teeth in this bill that really is going to bend the cost curve, at least if you want to bend the cost curve downwards, okay? And that's basically why I read this bill. I was looking for the loopholes. I was looking for the loopholes, and I was looking for what actually had teeth. And there is no teeth in this bill in terms of actual cost control. So here's the thing. This is going to be a huge aspect of debate in the fiscal cliff. It is going to be an even bigger aspect of debate in the upcoming debt ceiling negotiations that will no doubt come, and the deficit negotiations that will no doubt come. How are we going to do this? This is the real question. How are we going to do this? And frankly, from my standpoint, how are we going to invest in the healthcare industry when there's going to be a lot of absolutely inevitable pressure on prices and cost? So I guess one of the biggest points that I want to make, and sort of some of the closing thoughts I want to make, is every system, right, has to have some disciplining mechanism to allocate resources, right? Every system has to do this. Now, the two that we use most often in the developed world are centralized control and the market mechanism. So centralized control disciplines the scarce resources by basically saying who can have what at what price. Every developed country that has a health benefit that covers all of its citizens operates more or less in this way. Some of them are more central, like the NHS in the UK. Some of them are more of a utility model, like Switzerland, the Netherlands, even Japan, right? But that's not what we have in this bill. This is not a centrally controlled bill. The other way to discipline the allocation of resources is the market mechanism. And the market mechanism, right, is defined by a buyer and a seller. They come together at a point of transaction. Somebody exchanges some good of value for a price. And that those two things are transparent at that point of exchange. Think about your healthcare relationships. Not a single one probably acts that way. Why? Because when you go to the doctor, who pays the doctor? The pot of money in the sky pays the doctor, whether it's Medicare or the employer's health plan, right? You pay him him or her $20, $40. You pay that out of pocket. That's nothing. So why in the world are we surprised that there is an inefficient allocation of resources in this system? There is no real disciplining mechanism for it. That's going to change, and it's going to change in two ways. One, from a public standpoint, there is going to be a lot more public control. That is almost inevitable, and the question is how. And believe me, the lobbying groups that I talked about earlier on are on top of it. The other thing that's going to happen is there is going to actually be much more of a market mechanism move in the healthcare marketplace. And that's going to happen in a myriad of different ways. But I think that you should all anticipate that as we go forward into this landscape, there is going to be more of a public access system and more of a private access system, right? So that's going to be one of the key things that's going to define the debate about cost. How we're going to bring in some kind of disciplining mechanisms, whether they be centrally controlled or market-based. The other thing that I think is going to be really critical, and it's very interesting, I think, to think about from my standpoint as an investor, not only in healthcare goods and products, but also in health-related goods and services, which actually have included some agriculture, some food, vitamins, minerals, and supplements, and so on. Things that actually are driven by the same kinds of demographic demand trends, whether they be age or wealth, and so on. And here's the thing. In the Supreme Court discussion about the Obamacare, there was this kind of widely reported exchange where Justice Scalia said, you know, where does this end? Are we going to force people to eat broccoli? Now, I understand some of you are broccoli farmers. Maybe that would be a good thing. I don't know. But here's the bottom line, though. If we treat health care as a right, it is a very, very, very expensive right. And that right will come with strings attached sooner or later. And it's not probably going to be the feds that do it first. At the end of the day, who actually were the first movers in smoking cessation, right? The movement against tobacco and cigarettes. It was employers. It was office buildings. The feds, and in fact, I think one of the few buildings where you can actually still smoke in your office, I think, is still the Capitol building, or at least it was up until just a few years ago. But that's going to be the kind of movers that we're going to see in behavioral change. It's actually employers like Safeway who actually offer their employees differential healthcare premia if they decide they're going to enter a anti-hypertension program if they have hypertension, so on and so forth. There is going to be elements of behavioral change that permeate through the marketplace, and they're going to permeate through the marketplace. That's really where this action is going to take place, despite what Michael Bloomberg says about Slurpees. And finally, I would just say, as an issue about how we're going to get at cost control, we really are going to have to figure out a way as a culture to talk about this much more rationally. Because here's the deal. 2/3 of all healthcare costs are absorbed by about the top 10% of healthcare spenders in the system right now. Majority of that comes in the last 6 months of care. The dispersion in terms of how much is spent in the last 6 months of life is absolutely enormous. It is demonstrable, study after study. It is a fact that you go from southern Florida to Texas to the Mayo area, right, in Minnesota. You're dealing with dramatically different end-of-life care cost equations. And here's the thing. What was the single defining moment of Obamacare? It was the death panels, right? It was once the death panels idea got revved up, it started to get ugly. What was the death panels actually? The death panels actually was, the kernel of that was the idea that there was going to be payment for, essentially, consultation around living wills, right? What you want as an individual at the end of your life, what your family wants as an individual at the end of life. That was, in fact, the kernel of what became the death panels. This is maybe one of the central and most sensitive and most ethically difficult issues, and yet this is absorbing an enormous amount of healthcare cost. We cannot, as a society, grapple with the issue of healthcare costs until we can rationally discuss something like this. It's just that simple. That's the kind of magnitude. So at the end of the day, I honestly think, Obamacare, this is not about the government takeover of healthcare. As an investor, this is what's important to me. It, in fact, is extremely positive for industry. And frankly, the performance of a lot of the healthcare industry in terms of the stocks have actually borne out. I think that the market begins to understand this, ultimately. They didn't understand this in 2009, but they have understood it since. I think secondarily, we as investors, and this is certainly what my fund does, we have to look much more broadly. And that's why I'm looking at not just healthcare goods and services that play into the cost dynamic and the volume dynamic, but also in the behavioral dynamic as well. We're going to be paying more, and we're going to be more responsible in our own lives for our healthcare, whether we like it or not. And that's part of the reason why we've moved to a much more broader outlook in terms of how we invest in healthcare. So anyway, that's all.
I got a quick, how long did it take you to read that?
It took me 3 evenings and about 2 bottles of red wine.
Wow. Okay, our next speaker is Quoc Tran. Quoc's going to give us a little insight on what to invest in here in the future.
Thank you. Thank you for your attendance and interest. I'm very humbled to be here, especially with this distinguished panel. Thank you, Matt, for inviting me. Hopefully you guys saw the lunch speaker, and hopefully you saw the Trader Joe's speaker before me, so I feel very humbled to be here before you. I'm going to try and accomplish 3 things. One, talk about who we are, talk about how we invest, particularly post the election. Fortunately, it's the same way that we invested pre-election. And then I'll give you a few examples of what we do. We're a small boutique firm in Northern California. We have about 27 employees. We're employee-owned, and we run about $4.5 billion. The good thing about what we do is we eat our own cooking. We invest with conviction. We only buy 15 to 20 stocks. And I manage our funds, our employees' KEO program as well. So at the end of the year, we give a retirement contribution to all of our employees who've been with us over a year. And the only choice they have is the exact same portfolio that I have for you. So we literally eat our own cooking. Something magical happens when that happens. When we owned Costco, for instance, my assistant would check the receipt from Costco to make sure that they weren't overcharging us, but she made sure we always shopped at Costco. It's just really fun where there's an empowerment about that. When Matt asked me to talk about how we invest, I couldn't help but remember a couple years ago when one of my daughter's kindergarten teacher called me and said that they were going to have Career Week and asked me to come in to talk about what I do. And she said the really popular ones are people who come in with uniforms. So police officer, if you have a uniform, or a pilot, right, or a doctor with a stethoscope. And I said, oh my gosh, what am I going to do? Right? I usually wear khakis and a golf shirt. So I suited up, came in. I had my daughter hand out a fake $100 bill to every student, and I held up 3 annual reports. One was Apple, one was Disney, and one was Mattel. As you know, Mattel makes Barbie and Hot Wheels, and I spent a minute on each company. And I said, a show of hands, if you had $100 a year ago, how many of you would have bought Disney stock? About half of them raised their hand. How many would have bought Apple? Half. How many would buy Mattel? Half. And so clearly they vote early and often, just like Chicago, just like the politicians in Chicago. And so at the end of the day, I said, well, if you bought Apple, I would give you 150 back. If you bought Mattel, I'd give you 120, et cetera. A week later, I came to pick up Fiona from school, and one of her little friends runs up to me and says, you're Fiona's dad. I said, yes. He said, you're the one that makes money. I'm like, that's right, honey. So how we invest is kind of old-fashioned. We buy and hold, which seems so foreign if you watch CNBC. In fact, I tell our clients, don't watch CNBC because I think it's hazardous to your health. I mean, seriously. I mean, they bring out the end of the world guys, like when Europe was exploding in the second quarter, and the world didn't end, right? Because I guess that can only happen once by definition, right? So the world didn't end. And then the next week, they bring out the biggest bulls. There is no accountability for the people that they trounce out as experts. So don't watch CNBC, and it's no coincidence in many hospitals that they actually don't have CNBC in the TV channels because it's too stressful. And so, I think it's a joke. I think it's a complete joke. But back to how we invest. What we try to do at the end of the day is we try and find businesses. Let me take a step back. Investing, whether it's in bonds or stocks or a business, is ultimately buying a stream of future cash flow. Let me repeat that. You're buying a stream of future cash flow. And so as a participant in the public equities market, what I'm trying to find are a small handful of companies where the cash flow is predictable, where the balance sheet is not over-levered, and where I'm not going to pay too much for it. Because the best predictor of whether or not a stock investment is successful or not is the valuation at which you pay for it. So if you go back to the tech bubble, right, Coke is a great company. Cisco was a great company, and they still exist today. But if you overpaid for it, you didn't make any money. So valuation is super important for us. And we often think about our companies as what would a knowledgeable business owner pay for the whole thing. And then we take a 20% discount below which what we think a private market value is, below which we'll buy it for our clients. It's a very simple strategy. We only own 15 to 20 stocks. For risk management purposes, we limit our holdings in any one industry to no more than 2 names, so that we're not overexposed to finance, or we're not overexposed to healthcare. And with that simple process, we've been able to beat the market by 200 or 300 basis points a year for the last 5 years. And so the good thing about what we do is whether or not the fiscal cliff happens, whether or not the deficit increases or decreases, we're not buying the market. We're buying 15 to 20 good businesses, and we're trying really hard not to overpay for them. And one of the privileges that I have is I get to go around the country and sometimes the world and meet with the executives running these businesses. In fact, a couple months ago, my wife noticed that I had a meeting with Hugh Grant. And she said, so what are you going to meet with Hugh about? I said, Denise, Monsanto Hugh Grant, not your Hugh Grant. Right? He's the CEO of Monsanto, so thank you for sponsoring this. So she stopped, she moved on to something else. So that's as interested as she gets in what I do. And so we're looking for the growth of cash flow and the predictability of that cash flow. We've been doing it a long time, since the 70s in my firm. You know, I joined a couple years ago in 2005 when we were about $1 billion, and now we're about $4.5 billion. So even in this tough market, we've been able to grow. Similarly, the last chart that Dan put up, I'm a glass half full kind of guy, and it looked like the typical sideways markets were 15 years. I'm thinking just a couple more years of this, and then off to the races. But in reality, we've had 13 years of a bear market. 13 years of a bear market. And the reason why that's important is investing is forward-looking. Emotions are backwards-looking. And human psychology often have a real impact on stock prices. A few years ago when I was in Omaha, I was privileged enough to have a conversation with Warren Buffett. And he said, if you look at the newspaper these days, and there aren't many newspapers that publishes stock prices anymore, but back then we still had them. He said, look at the 52-week high-low of any company. So you look it up and you go, okay, I see it. He said, what's the spread? It's often 50%. And then he asked, do you think the business value has changed by that much in 1 year? And typically the answer is no, right? And if you own a small business, you know your business's value doesn't change that much in a year. So do your homework, pick your companies, and wait for the right price. And so that's what we try and do. And in times of a scare, that's often when stock prices are the cheapest. So that's when you'll see us buy and get bigger in our names. And in times of euphoria, that's when you start seeing us trim. Our typical holding period is 5 years, so our turnover is about 25%. So most of our gains are long-term in nature. So our clients appreciate that because they've already made their money. And our first mandate is to preserve capital, second is to grow it. And so there are a couple of examples that I want to bring up that helps illustrate this. One healthcare name is Express Scripts. Express Scripts is a national pharmacy benefit manager. They actually don't make any drugs. They help organize the healthcare benefit for their clients. Typically, healthcare spend in the United States is about $2 trillion a year, which is a big number. 15% of that goes to drugs. The drug component is the fastest growing expense within healthcare. So if you want to contain the cost of healthcare, one easy way to do that is to contain the growth of the drug spend. So what Express Scripts tries to do is they try and move people towards generic. So Lipitor went generic in November of last year. If you switch from branded to generic, it saves you $100 per month per patient, which is a huge savings. They also try to encourage, when appropriate, to take mail order. So half the drugs that we take you can take as maintenance drugs. It's cheaper to take it in mail order form. So Express Scripts works with employers and tries to lower the cost of health care. Last year, one of their vendors is Walgreens, and Walgreens didn't want to renew with Express Scripts unless they got paid more. So Express Scripts went back to their customers and said, Walgreens wants to pay more. And they said, well, can you fill the scripts without Walgreens? They said, well, actually, within a quarter mile of every Walgreens, there's a CVS. So yes, we can fill the scripts without Walgreens. They said, well, we'd like to have Walgreens in the mix. We don't want them if we have to pay more. So Express Scripts said no to Walgreens. And the headlines was, Walgreens doesn't renew with Express Scripts. And so the stock dropped 22%. For us, we knew that Walgreens was a vendor, not a customer. And we knew that Express Scripts probably wasn't going to lose a lot of customers because they could fulfill the prescriptions. So we took advantage of that drop and made Express Scripts a 7% weight for us. Typically, we have a 5% starting position. Fast forward to this summer, Express Scripts finished their merger with Medco, which is great, and Walgreens came back to the table and they re-signed with them. So they were up over 40% by this summer. So we sold a third to a half of our position. We still have a core position, but we will take advantage of headline scares and boil it down to an individual basis and make our stocks bigger or smaller. But had we not made it big, we wouldn't have enjoyed this run. And now that it's a little euphoric, we'll take some off. There are two other examples I want to share with you. One is, in both of these examples, I hope to illustrate that whether we're in a 2% GDP growth or 0, or hopefully not a negative growth, but in a slow growth environment, we believe we can find you companies that can power through. One of these is in the smartphone industry. As you may know, there are about 7 billion phones in the world. Only about 20% of them are smartphones. And the reason why this is important is about 2 years ago, the new phones that were being bought, over half of them were smartphones. So the lines have crossed where now a majority of new phones sold are smartphones. So whether or not we're in a 1, 2, or 3% GDP growth environment, smartphones are actually growing about 35% a year. So you have a very strong secular tailwind in smartphones. Within the smartphone space, there's a little company in La Jolla called Qualcomm. Qualcomm invented CDMA. It was founded by Irwin Jacobs, who was an MIT professor. CDMA is the technology that makes 3G works. And in 2007, they had a competing standard called GSM, which is based on the European industry standard. The Europeans picked CDMA over GSM as the standard for 3G. This was critical 5 years ago. What that means is today, and from that point going forward, every smartphone maker in the world has to pay Qualcomm a royalty about 3.25% of the wholesale price of the phone. Whether you're Apple or Samsung or Nokia, if you sell a 3G smartphone, you pay Qualcomm a royalty. This royalty is contractually based for the next 15 years. So the cash flow stream on this is tremendous. This royalty income is 20% of their revenues and 80% of their profits. Why? Because the cost of the royalty is nothing, right? And so you have 90, 95% margin on this royalty. So Qualcomm, the stock's about $60, $61, $60. They have $15 a share in cash, no debt. Let me repeat that, $15 a share in cash, no debt. They'll earn north of $4 in earnings this year, and they'll grow 15 to 20% for the next 3 to 5 years. So you're getting a high quality business with extremely good visibility on their cash flow, and you're paying about 12 times earnings for that. This is our largest position at the firm. So whether we're in a growth scenario or a recessionary scenario, people want their smartphones, particularly as emerging markets develop. The next example I'll give you, so the name like a Qualcomm makes up, with that high visibility, we call them double-digit compounders, make about half of our portfolio. In times of stress, of course, it's frustrating to see the stock prices go down, but you'll see me buy more of it. And if Qualcomm gets excited and people drive it up, you'll probably see me take a little bit off it. But names like Qualcomm make up about half the portfolio. Another area that we find very helpful and fruitful are spin-offs. Oftentimes, when a company spins off a division, the senior management of that company, often for the first time in their career, has control of allocating capital. So they can invest in areas where they think they need to, and they get incented and rewarded for their own merits. So a couple years ago, NCR which you may know stands for National Cash Register. They make cash registers. Spun off a company called Teradata. Teradata is a data analytics company. So if you ever made a purchase at Walmart or Target, there's a lot of data that's generated. There's the items you bought, the price, the credit card authorization. All that data is stored in a data warehouse. And Oracle does a great job selling these warehouses. Teradata is a layer of software that sits on top of the data warehouse. And what they do is they analyze that data. And by analyzing that data, they help companies make smarter decisions. So Walmart is one of their customers. They analyzed Walmart's data. They came back to Walmart and said, Walmart, do you know what sells out before a hurricane? Yeah, we're Walmart. Water, batteries, flashlights. Teradata said, strawberry Pop-Tarts. Really? Why? I said, that's what the data tells us. Not chocolate, not blueberries, but strawberry. So now, as you can imagine, Walmart has their own weather center. Before Hurricane Sandy hit, every Walmart in Hurricane Alley has strawberry Pop-Tarts. Boom, 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 boom. They sell out. Another insight that Teradata, you can't make this up, right? Another insight that Teradata told their retailers is if you put diapers next to beer, you sell 40% more diapers. Really? It's like, why? Maybe because the men are being sent to the shopping. So now you'll see at Kroger, Safeway, seriously, you'll see diapers and beers paired next to each other. But this drives revenues, right? So in a low growth environment, Teradata helps businesses drive revenues. Now, there are other more sophisticated examples. So for instance, if you ever bought something on Amazon, and they'll say, other customers who bought this also looked at these books. That's Teradata. If you bought something on iTunes, other customers bought, Garth Brooks' album, also bought these albums. That's Teradata. And so, we bought Teradata in 2009, in the 20s, sold it earlier this year at 72, and it's on our radar. We don't currently own it now because we think the valuation is full. But Teradata is a good example of a spinoff that usually makes up about a quarter of our portfolio. And it's often underfollowed by Wall Street analysts because in this specific example, the NCR analysts aren't the right analysts to cover data analytics. So there's often a 3 to 6 month period where there's no coverage. And so that's when we'll go in, do the work, and if the valuation's right and the thesis is right, we'll buy it. The remaining quarter of our portfolio are in special situation companies where we'll find an interesting thesis that'll take 3 to 5 years to play out. One example of that is Starwood Hotels. They own 11 brands from the St. Regis to the Westin to the Sheraton to the W. Most people don't realize this, but in 2005, a new CEO came in and the CFO came from McKinsey. So like a good consultant, he commissioned a study on the hotel industry, probably done by McKinsey. And they realized that the best hotels in the world actually didn't own the hotels. So the Four Seasons and Marriott came out as the best hotels in the world. And they actually are pure management companies, and local owners own the hotels. So Starwood in 2005 embarked on a journey where 75% of their profits that time was from company-owned assets to selling the assets, but maintaining long-term management contracts on the assets. So today, only about a third of their profits come from company-owned assets, and every asset they have is for sale. So at the right price, they'll sell the St. Regis in Manhattan. And so what that means is from this point going forward, their stream of cash flow is a lot more predictable. A management contract generally works like this. It's 20 to 50 years in duration. You get about 3% of the top line and a percentage of the profit. And all the costs of operating the hotel, from the employees to the maintenance, gets pushed on to the owner. Why would an owner agree to this? Well, because Starwood and Marriott and Hilton have great relationships with corporate customers, and they can fill the hotels at a higher occupancy and a higher rate than a boutique owner would have on their own. There are two other interesting points of Starwood. Since 2008, no one is giving anyone $100 million to build a brand new hotel in Scottsdale or New York City or San Francisco. What that means is the incumbent hotel owners actually are seeing occupancy get back to 2007 levels. Actually, I tried to stay here last night. It was completely full. So I stayed at the Westin, which happens to be a Starwood. So owners are beginning to raise rates, and it takes 3 years to provision and build a hotel. So there is no supply growth in the U.S. and Europe, which is great for the hotel industry here, because occupancy is back to 08, 07 levels. The second thing that's happening to them is in the emerging markets, the Chinese and the Indians are all under-hoteled. The Chinese have a 300 million middle-class population, so about the same size as our entire population. They have 1/10 of our hotel rooms that are of Western standards. And so 80% of Starwood's incremental growth are in hotels in China and India, none of which they have to put a dollar down. They have 100 hotels in China. They're opening 2 hotels a week this year in China, none of which they have to put a dollar down. And so we're able to get Starwood at current prices at about 10 times cash flow. And so why is it cheap? It's because it's in the hotel industry, right? We're in a slow growth environment. Why would anyone want to own a hotel? Well, my time horizon is 3 to 5 years, not 3 to 5 months. And so I'm able to pick up these stories when they're most hated. So I want to make sure we left time for Q&A, but thank you.
Thank you, Quoc. Well, now that we've heard from everybody, let's take some questions from the audience. Anybody have some questions for these guys? Vernon.
What food and ag companies are you holding?
So what food and ag company am I holding? So right now, most of our businesses that we invest in are B2B services. So we used to own C.H. Robinson, for instance. That's a trucker that helps move a lot of produce. We don't own any specific ag. We have looked at Monsanto and their competitors. We haven't made a decision yet. But we're looking for predictability and high return on capital. So we're probably going to skew more towards services than actual companies that make real things.
John?
For the, the middle panelists, I did catch it.
Yeah.
But on this healthcare deal, most of us in the ag industry have literally several thousand employees per firm, and our margins and our contracts to Quoc Tran are predicated on a cap. Mostly speaking, whether it's 50,000 or so, but going to unlimited. You know, that's why I don't see how this could be possibly doable for a firm like us. We're not going to afford it.
So you're referring to the pure insurance regs about guaranteed issue, no rescission, no lifetime cap.
Exactly.
And what you're saying is that under those auspices, your pool, right? You'd have to price that up significantly in order. Yeah.
Your margins use 1,000 employees with 50,000 cap. How do you,
Right. Well,
price then you?
yeah. So I think that this is going to be, and you know, it's obvious, but you've put your finger on one of the big battlegrounds that we're gonna see going forward. But what I would say is, and this is of course like a sort of an unsatisfying answer, this is one of the reasons though why I think what you're gonna end up seeing is you are gonna end up seeing employers drop a lot of coverage, and you are gonna see folks get put into the exchanges, because the only way, even if it may still not, but the only way to solve that issue, right, is a much bigger pool. You know, I mean, that's the only way to do it. That's what the entire individual mandate was theoretically all about. That's what the insurance industry used as their quid pro quo, and I think that ultimately they understand that I'm talking broad industry speak. They understand that there is going to be a natural momentum to having more and more folks covered in that sort of larger pool in those exchanges and so on. Now, it doesn't help you, right? That's not going to help you right away.
I'm going to have to force them in exchanges, drop the coverage. My customers, clearly in the short window, aren't going to accept price increases for me to pay the premium to go to lifetime or unlimited. And so our simplistic mind goes to pros are thinking it's a great way just to force socialized medicine. I have no choice.
Yeah, so I mean, I think that the only thing I would inject into that is, what I'm saying is it is definitely creates the additional momentum to shift employees into the exchanges. The exchanges, though, are not a public option. So when we talk about socialized medicine, what we're talking about in terms of the exchanges, we're talking about private insurers, we're talking about United Healthcare, we're talking about Aetna, right? We're talking about WellPoint, that are going to be the players and the Blues. The local Blues, that are going to be the participants in the exchanges. So if it's shifting people onto the exchanges, it doesn't mean they're shifting them onto the government dole necessarily. What they're doing is they're shifting them into that pool of folks that are going to operate in that way. That's why I said early on, for the companies like United Health that understand that the momentum is towards being that kind of a provider, they can handle thinner margins on bigger populations, right? And that's the whole idea of the individual mandate. That was the importance of the individual mandate as a quid pro quo. But again, it's dissatisfying because what I'm telling you does not help you. And I think that what plans like yourselves are going to be grappling with, is very much along the lines of what you're discussing. Now, the only thing I would say is you do need to talk to your attorneys and so on, because there is currently a safe harbor for grandfathered health plans that you may be familiar with. There is a safe harbor right now with there's no termination date. So for instance, if you had a plan as of March, whatever the signing of the bill was, March 23rd, 2010, it is the safe harbor discussion that says not only current employees, but new employees can actually go into that same plan that's grandfathered along. Now, and so that actually, that will not be subject to exactly the same kind, no rescission and so on and so forth. Now, the expectation is that that's coming down the line, right? But from a standpoint of like January 1st, 2014, technically there's a safe harbor for plans like yours. Again, you are correct in terms of the momentum. But I guess what I'm saying is these are issues of shifting momentum rather than any kind of drop dead requirement. You know what I'm saying? Like that's all I'm trying to temper the. But I mean I'm with you. Well, I mean, to me, it's not so much, and certainly we actually, one of the places where we succeeded very much in our fund was in 2009. There was probably no more maligned sector than the health insurance sector, whether it be United Health, Aetna, Cigna, so on and so forth. I mean, the valuations had gotten to historical kind of trough levels. And nonetheless, day after day, the drumbeat was, government takeover of healthcare, the public option this, the public option that. The public option, by the way, never, not for one moment, not for one day of any of the debate had the votes to pass. Not one day, right? We actually ended up purchasing a lot of those companies at a very, very attractive valuation. So we've played it that way. I think that at the end of the day, though, my point is, just broadly, like I said, kind of what point of 32 million new customers do we not understand? The number of uninsured people in the United States is equivalent to the population of the 25 least populous states in the Union. Now, that's not the right way to look at it, of course, but if you just were to say as a business person, half of the land mass of the country contains, a population of half the land mass can't buy your product, right? And we hear a lot about emergency room medicine, but at the end of the day, uninsured people consume it may be half as much, maybe, but the academic literature suggests much, much less. So this is about a significant, and certainly in the near term, a significant expansion of paying customers for healthcare stuff.
Exactly. Now, do you think this is going to definitely spur on a cottage industry? Because I am not going to read that bill you read.
I don't recommend it.
But I got to find some expert help on
yes, you do.
Where do we find that help that's
so most,
objective?
Yeah, well, I can't direct you in a particular place. What I'd say is most, law firms, most major law firms, even sub-major law firms, now have specialized practices. This is all they do.
It's the Full Employment Act for lawyers.
Incidentally, speaking of Full Employment Act, so one of the ways that I tried to figure out how the growth of the healthcare industry was going way deep into the BLS statistics, I went to the micro level where they actually break it out by these ridiculous job functions. You can even find like the number of dog catchers and dog walkers and personal massage therapists that there are employed in the United States. And one of the single biggest growth areas over the last last 2 years, I should say, after the bill had been signed, HMOs. HMOs are staffing up. They're staffing up because they're about to have a lot more new customers. Incidentally, I'm sorry to monopolize, but this is just this stat I just have to share because one of the most astounding things about this when we think about the employment picture in the United States and the overall sort of picture of economic health, since 1960, 45% of all net jobs added in the United States happened in 2 BLS sectors. One of them was in education and healthcare, which is predominantly healthcare when you think about growth. The other one was government, that's state, federal, and local. Since 1990, that percentage is 65% of all net jobs were added in those 2 sectors. From 2000 to 2010, the stats become not meaningful. 850% of all net jobs were added in those 2 sectors, largely because we added essentially no net jobs, and yet healthcare and education go this way. In fact, 2000 to 2010, government employment idling along flat, even having negative years. So what we're talking about here is, and this gets to the cost issue longer term, which is we've seen this absolutely monstrous shift of all of the productive resources, of the wealth generative resources in this country focused in very small sector when you think about the breadth of the U.S. economy.
Okay. Gary?
When do you see the Fed having to raise interest rates, and when they do, what's going to prevent a bond spin-off? When you look at the 10-year Treasury rate, 1.2, whatever it is, you look at corporate bonds that are just slightly more, that to me looks like a disaster in the making.
Well, it's very simple. If you define, the Fed is keeping rates exceptionally low. If you define exceptionally low as 0, the answer is different than, let's say, less than 1%. If you define exceptionally low interest rates as less than 1%, I won't make even money on it, but I'd take 2020 as when you'll probably break through 1%. Now that said, the more relevant question that people ask is when is the first interest rate hike going to come? Without getting into the specifics, there are a number of things that have to be done before the Federal Reserve can raise interest rates. I think you're probably talking 2016. I mean, right now the Fed is telling you until 2015, so I have a running head start here. But I think 2016 is probably when you're going to see at earliest. And let me be clear, the larger dynamics at play in the economy push the weight further out rather than closer in. So this is why the 10-year, it's not 1.2, it's 1.8, but that's why the fixed income market is doing what it's doing.
So when do you see the housing shortage surplus turn into housing shortage?
Well, that's a much more difficult question. I mean, certainly you've seen a turn in the housing market. There's no doubt about that, and the Federal Reserve has been an instrumental part of that. What we've started to see, one of the major problems for the housing market for the last couple of years was what we call household formation, meaning there just weren't as many people either immigrating to the United States or, more relevantly, moving out of their mom's basement. What you've seen in the last year and change is that it's returned to a more normal level, and as demand for housing has picked up, this has to be viewed in the context of the last couple of years. We really haven't built many houses. At the peak, housing starts were, if I remember correctly, 2.2 million houses on an annualized basis. Now, at the bottom, they were 400,000. So there was a huge drop-off in construction of new homes that started to pick up now, and so you started to see prices firm and demand pick up. But tying that to the Federal Reserve, they're more likely to err on the side of keeping rates too low for too long.
The questions out here.
Dan, have you got any
We need a microphone. Is there a mic out there? Oh.
Used to be if you had a deficit of 6%, you know, you feel like you're a banana.
A government deficit.
What's that?
A government deficit?
Yeah, government budget debt over 6%, or if you were close to 100% of debt to GDP, or banana republic. Those dynamics change, and at what number would you be concerned on debt to GDP for our federal government?
To answer the second question first, for people who couldn't hear, it's at what point is the U.S. a joke? So to answer the second question about what level of debt to GDP bothers people, it's somewhere between 90 and 100%. But the answer to your first question pertains to the second as well. This is a really in-depth conversation, but if I could boil it down, there's a big difference between what Colombia can get away with and what the United States can get away with. And the best example, the best refutation of the insinuation of your question is Japan. Japan, for those people who may not be aware, in 1990 suffered through a similar a housing bubble and a stock market crash, not dissimilar to ours, and the economy has never recovered. The stock market is now 70% or so, 75% below its December 28th, 1989 level. Their debt to GDP, their gross debt to GDP is now 200%. Well beyond what Greece is suffering from, well beyond what Spain is suffering from. Yeah, and the 10-year JGB, ours is 1.8. The 10-year Japanese government bond fluctuates between 0.8% and 1.2%. And they've done everything short of just throwing yen out the window. So the answer to your question is, we're getting to the point where you really want to, and that's why even Democrats are on board with saying maybe the debt level's too high. But that said, developed economies like the United States can do things, developed economies with a central bank like the Federal Reserve can do things other countries can't, and we're proving that again right now.
Any other questions out here? Oh, right down here.
Some of that is our companies are more multinational now than ever before. 40% of the S&P 500 revenues come from outside the U.S. Quoc has 75% of the revenues coming outside the U.S. So it's a much more global corporate structure than a local U.S. employment rate. The other thing is we've pivoted to more of a service economy than manufacturing. I'll give you one example. There are companies that are public now that didn't exist as recently, as 10 years ago. Visa and MasterCard are public companies now. The operating margins at both companies are 50% plus. The incremental swipe, when you swipe a credit card or debit card, is 90% profit for them because it's completely automated. They can both double their volumes without hiring another person. So they're different businesses that we're operating in now.
But let me just make a larger point here, and some people yell at me when I say stuff like this. I'm sympathetic to the view that there are a number of people the economy is moving, to tie this back into politics, the economy is moving at warp speed right now. And businesses and policymakers are to a large degree falling behind. And admittedly, if you didn't pick up on it, I'm somewhat of a libertarian, but there is a role for government in terms of trying to push the private sector economy in certain directions. Admittedly, they screw it up 99.9% of the time, but the economy is moving at a very rapid pace. That said, businesses and companies, and there's a lot of CEOs and managers in the room, have only one obligation, and that's to the bottom line. And it sounds horrible, although capitalism is in some respects horrible in this regard. But businesses, if they can generate the same or better profit with fewer employees, why should they not? And the best example I always get back to in terms of encouraging employment or protecting employment in the context of what happened with the car companies is the Walkman. What happens if in the 80s someone decides the production of the Walkman employs too many people and it should be protected? I love my iPod. And I'm a musician, and we most certainly would not have the iPod today if not for that. And I promise you, there are fewer people employed in the United States making the iPod, which is to say 0, than that were making the Walkman.
But you know, the other dynamic is the one that I pointed out as well, which is that part of the place where we're losing employment is government employment, right? Which is not going to have any kind of corresponding dynamic in terms of corporate profitability at all. And from an employment perspective, honestly, the takeaway I took from my own analysis was, you know, if you look at the debt ceiling debate last time around, you look at all of the deficit talks. I mean, like it, don't like it, the stuff in the crosshairs is predominantly government employment and healthcare. I mean, healthcare at the end of the day is by far a bigger budgetary problem than is Social Security or many of the other issues that we're talking about, and is certainly in for potentially sort of steeper cuts. You know, from a forward-looking perspective, if that's where we're focused in terms of our cuts, and that's where the growth of employment has been overwhelmingly centered, then I think, you know, that's another way that this kind of becomes a disjointed picture.
But wait, let me say one thing very quickly. And I apologize, I'm going to project onto you. You know, there's this you know, the crowd oohs and ahs when we talk about government employment going up in the healthcare and education sectors. You know, one of the problems that we don't yet have in common with Japan is the fact that we are getting older. And you talked about, and everybody should know, a lot of healthcare is consumed in the final 6 months or even 2 years of life. As we get older, and we're encourage, or we're sort of engendering longer outcomes, but not necessarily better outcomes. You need, my mother's in the healthcare industry, so I'm sort of sympathetic to this debate. You do need more people employed in the healthcare and education space. I mean, we have 310 million people living in the country right now, and increasingly more and more of them are over 65. So there is going to be employment opportunities by default in those industries.
Oh, I absolutely agree. But again, my only point is we're talking about sort of how it is that the employment picture has become sort of disjointed from the corporate profitability picture. And my point here is that one of the things that is happening, and granted, healthcare employment has not, as I said, has not gone anywhere but up. Government employment, on the other hand, is a different story. It has actually been down. It has been flat to down for most of the years of the last decade, and has actually accelerated in the last 3 years. So my point is that
Barack Obama's presided over the smallest
growth in government. It's been declined.
The great socialist.
So there's absolutely, yeah, there's no question in my mind. I mean, look, at the end of the day, what's going to happen to the over 65 age population, as I'm sure many of you no doubt understand, right, is that it's going to go from a growth that's been running at the low single digits to the middle single digits to even a couple of years projected sort of not quite the upper, but sort of the middle to upper single digits. These are people that cost 2 to 7 times as much per capita, consume 2 to 7 times as many dollars per capita than does an under 65 age worker. There's absolutely no question that what you're saying is true. On the other hand, there's also absolutely no question that the central budgetary pressure is going to get brought to bear on the healthcare industry because it is the single fastest growing, biggest issue ahead. And that will temper, I think, some of what has been the extraordinary growth, as I mentioned in those stats, extraordinary growth and concentration of employment growth in healthcare.
And let me get back to your question very quickly. What worries people who manage, whose personal wealth is measured in B's, not M's, and who manage B's, not M's, what worries them, even though many of them are Steve Wynn type Republicans, is that I can very easily show you the charts and draw you the data that there is a relationship between corporate profitability, corporate margins, and the budget deficits that the government has been running. And what worries those people is what happens if and when too aggressive an austerity package is brought to the United States. Even though ultimately it may be good in the 10 or 20 year, there's a lot of concern with respect to profitability and profits in the near term if something goes wrong at the government level. AKA they screw up a fix, if they screw up a fix. That is a worry among people who matter and manage lots and lots of money.